we're going to rewind a little bit. I know it's tough without the visual, but we have a new trade coming our way. And, you know, in the same manner that I did the final hour trade, I did 100 trades online. We're going to do the same thing with the new Batman trade. And the Batman trade, just so we're clear, is this guy down at the bottom. It looks like the ears of the Batman because it's two butterflies side by side, and we put them on so that they're both bullish and bearish and cover us in both directions. Our classic trade, we just pick a direction. That's the one that you see up top. And it has some wonderful characteristics to it. One is that even though it's only a 50-50 trade, because of the asymmetric nature of it, we are very profitable. I mean, well, at least in my case, anywhere from 5 to 7% per month. And that's this year during a bear market. Last year during a bull market, it was more like 11 to 20% per month. So that has some wonderful characteristics to it. The things that some people have a hard time dealing with is the fact that it is only a 50-50 win rate. And the problem with a 50-50 win rate is that you can go through streaks, winning streaks, losing streaks. The winning streaks are not a problem. Losing streaks can be a problem. So in the last year, I've had at least 3 instances where we've had losing streaks of 5 days, and one instance where I had losing streak of 7 days. Now, for most people that are coming into a strategy, that is just not. It's very difficult for them to handle, especially because they just don't have the ability to look at the long term. And if you're coming in with a trial, right? You're coming in with a trial, and I give 4 weeks for the trial, so it can account for that. But even so, you can go through these periods where everything is going sideways, and then you can have this. And so most people, they look at that and they go, "What the hell is this? This strategy sucks." I said, "No, it really doesn't suck. I mean, we're making 6% per month, and it's really quite good." "Yeah, but you're losing all the time." All right, and that's their perspective because they're only seeing a small portion of it. So hard to convince people otherwise unless they've been with it. And I can't do trials for months so that you can see the efficacy. So I decided that, okay, we have to give up something to get something. And so what we give up is a little bit of risk. So we double up on the risk, but we increase the probability of profit dramatically. And so we go from 50% to probably somewhere, and I don't know exactly what the number is going to be yet, and that's going to be part of this experiment, but I believe it will be north of 75%. What we don't give up is the asymmetry, and that's key. Now, we're essentially putting on what is called a poor man's strangle. Now, of course, a strangle, and I'll just draw it over here in the middle. Let's say that this is your risk graph. A strangle looks like, oh man, I always do that. I didn't get the color right. For some reason, it defaults down to the dark area. I don't know why it does that. But a strangle is a long put and a long call. All right, so obviously this is your long call, and this is your long put. Now, there's a fair amount of risk here. And the profit curve on something like this, when you first open it, will look like this. All right, and as the day goes on, let's say you put this on as a day trade, that profit curve is continually moving down like this until it fills up the strangle. Now, what you're hoping for in a strangle is that you you move either this way or that way. And that's kind of interesting. So you're hoping for a big move, but what happens with no move? Well, then you know, you're in no man's land. No man's land anywhere from here to here. So you need a movement. If you don't get a movement and you only have the end of the day, and that doesn't really help you on a 0 DTE. Now you could go with a short strangle, right? So a short strangle is probably a little bit closer to what we're talking about. So a short strangle will also has, now this has a short put and a short call. And it looks like this. Almost like a condor, but it has undefined risk on either side. You are here and you are here. And its P&L looks something like this at the start. That's really designed for you to be at the money when you put this on, much like an iron condor. Of course, an iron condor has legs and defines your risk. That's what an iron condor does. But this, obviously there's problems with this. Undefined risk really sucks. And one of the problems with the iron condor is that you really have to make the spread really wide in order to get your probability of profit up around, I don't know, 80 to 90%, so that all you retail traders feel comfortable. And there's lots of issues with this. First of all, you have the undefined risk. You have great premium action, but still, we're only in the market for what, 6.5 hours, right? So in 6.5 hours, we have to make sure that this is wide enough, and we have enough profit here, right there, that that we're not afraid that we're going to get too far out this way or too far out this way, and hit that undefined risk. And even with a now, when you put on an iron condor, if you want to define that risk, this is what happens. And this is the problem with iron condors when you're doing 0 DTE. Big problem. So here, we'll do the 2 right here. So in order to fix the problem of undefined risk, you have to put on legs. Now, and if you want to have them wide enough, then what happens is that you have something that looks like this. Very, very tiny potential profit with pretty big risk, but it's wide enough that you get your 90% pop. That's now here's the other problem, that you've got this gamma risk on either side. As this grows, and quite frankly, you're just hoping that you don't go this way or that way that much. And even if you do, and you stay in between here, you start losing money. And if you start getting close to these legs, becomes untenable. And this is the problem that most people have with the other 0 DTE strategies. They look at this and, oh well, they usually put on stops like here and here, so that they can protect against the the risk. Now, it's not undefined risk, but it's still big. So how do you solve all of this, right? Well, the way we solve it, our first way to solve it was just to put on a simple out-of-the-money butterfly, right? And Sure, we're not, we're directional, and we only win 50% of the time. However, our return is fantastic because our risk is super small, and because we can make profit outside of the tent, as this grows, we have all this space here where we can make profit. And most of our profits are made out here, and some of them are made in here. But it's a 50% pop, which a lot of people don't, they don't like that. So this is what we did. We went to the Batman. Batman. And now we can act like an at the money trade or a neutral trade. And we put on trade like this. And then our profit curve at the start, it looks like this. And then as it grows, it starts looking like this, right? And this continues to grow up. And then this lifts for a while, and then it starts going down, right? So it's finally like this. Now that's really cool. That creates a very interesting dynamic during the day. And the interesting dynamic is that you have a lot of time if price is spending its time going back and forth here to make a decision, and really not be worried that much, because you can control if you feel like it's not going to go, towards the profit tent of this guy or towards the profit tent of this guy. You can get out with either a small profit or a very small loss in between here. All right. And if you're the big fan of the iron condor, you're already, that's what you're going for, small profit. All right. You never get a chance at a big profit. However, with ours, you get huge chances at big profits. So if it does come anywhere close, between here and here, trying to equate that to the iron condor up here. Maybe I'll make the iron condor a little darker so you can see it. So the iron condor is up here. And the iron condor's profit is always small, and there's big risk. So it only has this much profit to look forward to, all right, throughout that entire range. For us, small profit only happens in a very narrow range right here. And then the rest of it is big profit. See the difference? Are you getting the picture? So as the day progresses, and hey, look, most days you have movement, unless you're just moving, no movement for a long time, which I suppose can happen. All right, so we got I think we have some questions here. Our bullish side is going to pin, bro. I don't think so. I don't think it is. We'll talk about today's trade in just a little bit. So Void Realms wants to know 20 wide each. Yeah, we've been experimenting with 20 wide. 20 wide is seems to be our sweet spot for the width of a fly. and anywhere from a 1 to 6 to 1 to 8 risk to reward. Let's see. Gloria is asking, I want to ask something. If I do this strategy with 2 broken wing butterflies, yeah, I don't like that, and I'll show you why in a second. Yeah, whether it's reverse or whatever, I don't like it. And I'll show you why, because it starts to get you the same kind of profit curve shape that you get with the iron condor. I mean, it's not too bad, but you have to stay in the trade a lot longer in order to benefit from it. And let me show you what Gloria is talking about. So Gloria is saying, hey, well, what about if I do a broken wing butterfly, 2 broken wing butterflies, and maybe they look like this. Right? So then I have hardly any risk here. Now see, the problem, there are 2 problems with this, Gloria. One is that this risk here that we have otherwise, that's down here, it's not a problem to manage. It's an easy problem to manage. And in most cases, we actually, for time being, have profit here. Now, in the case here, your profit curve is going to look like this. It starts here. And you see this drop off here. It's always falling away from you. So when you move even into the butterfly, and as this grows, it's falling away from you, right? Where if these legs are up here, right, it's growing. It takes you don't get the benefit of this strategy until much later in the day. With the way we're doing it, that you get the benefit of this growth in here much earlier in the day. And you never really have any risk here anyway, so it's not a big deal. All right, let's see, we have some other questions. Juan says, in each one, I have automatic profits from the cost of the operations plus profit of at least 30%. This is, let's see. And the probability that one of them will close is high. I open the purchase strikes according to the volatility in the options chain. Do you think that this is, it's okay? Am I missing another portion of this? I'm not sure. Let's see. I have to put all this in context, Juan. In each one, I have automatic profits from the cost of the operations plus the profit of at least. Yeah, I'm not sure exactly what you're talking about there, so it's hard for me to, make a judgment on what you're asking. All right, so now Gloria is saying, well, what about the other way, where we take on huge risk in between? And all right, so now she's asking the reverse. Let's make these backwards. That might actually not be a bad idea. And we're open to all these different types of strategies. All of them are better than, so what she's talking about now is something like this. Right? Now, this, so you come on here, and you'll start out with a very flat profit curve. And during the day, what will happen is that this won't go up at all. It'll start going down almost immediately. So this will start doing something like this. Right? And then a little later in the day, It'll go like that. So if you're spending any time at all in here, in the mid part of the day, see, this strategy, what you're talking about, Gloria, would be a good thing to put on if you're expecting a very high expected move. All right. So this would be good for a high expected move where you're looking to vacate this area. Yeah, you want to vacate that area because it's bad. This is bad. We need a nice bright red. This is bad here. You want to vacate that area. So so that strategy would be good for a high expected move. But for just about anything else, a medium or a low expected move, you want to protect yourself because there's good chance that you're going to be in this area for a good portion of the day. All right, Ray's saying short wings on outside, but cannot do PDT hack with broken wings. Yeah, that would be a problem. What Ray's talking about, the PDT hack, is something that we've come up with that helps out small. We can close one of these and lock in profits. We'd have to think about that. But I still like Gloria's approach if we have a high expected move. All right, so let's go back to what we're talking about. Now, there's all of these are options, and there's many other things that we can consider too. All right. So here's our main new strategy. And then our profit curve will start like that. And then as it grows, it'll actually grow up like this across. And then as it, then it'll be like this. And then finally like this. And then it will, that's the way it goes. All right. So the cool part is that you're protected here in the middle for a good portion of the day. There is some point where this starts dropping down, and that case is an edge case. That's one of the edge cases I was going to talk about, where price is going back and forth and not making much headway one way or the other. And we actually had a day like that on Monday. All right, so Dan Smith is saying the PDT hack works on any spread combination or a combination of spreads. So it shouldn't matter if it's a broken wing or not. All right. Yeah, that makes sense because you can do it on any spread, right? So why not do it on a broken wing? So it should work fine. All right, so this is our preferred way because this gives us the greatest dynamic, and it will also increase our probability of profit, probably to about somewhere to 75 to 80%. And because we have the risk to reward, our risk is very small, easily manageable in this area. And then all we have to worry about is how we take profits when we're here. All right. All right. Let's see. Juan says, I open both operations symmetrically. I sell each one at the current value plus or minus the expected volatility with a minimum amplitude of 20% of that volatility. You're using all these big words. I don't know what you mean by minimum amplitude or both operations. Are you saying those are both flies? Is that what you're talking about? I don't know what that means. And how do you sell it at the current plus or minus expected volatility? Yeah. I would have to really, see this strategy because I'm not sure exactly what you're talking about there, but that's okay. You put on automatic profit on both the cost of operations plus 30% plus, which is the profit. Yeah, I don't like this this sort of systematic approach at all. Any kind of systematic approach, I am not a fan of. It's not going to work, in my view. I mean, you might have a system that works in all different markets, maybe, but I've never seen it, and try to move away from it. Yeah, I know it's hard to explain. That's okay. We can talk about it offline too. I'd like to understand exactly what you're talking about. All right. So Gloria says, thinks, but I was think broking and other in the middle. Other hanas or other bananas? I don't know what you're thinking there, Gloria. All right. So here's some other things that we can consider. We could even put a little directionality into this too. So if we're in a trending market, with the availability of the SPX and the XSP, which is 1/10 the XPS, and also the E-mini S&P, which are basically three different sizes, or all three have different margin requirements, where SPX is the biggest, the E-mini is in between, and the XSP is the smallest. And of course, you could also go the micro ES2, but its liquidity is super small at the moment. We could, if we were in a trending market, we could put on a larger fly or a wider fly or a different asset type outside. So let's say that we have a trending market that's going north, right? We could put on a big fly here and a small fly here, like that, right? And adjust it for our risk. So that's another idea. So let's take a look at the markets and see what we had going on here. So these are the two flies that we put on today. We profited earlier when it went up here, all right? And if there are two different things that we could do. When it got up here, I personally took this and hedged it so that it locked in a very tiny loss, like $5. And then took the profit from this up here. And then it vacated the premises. If you were still in this fly, you could have profited up here and down here. Or if you just decided to hold on to it until the end, you could have profited up here. So there are multiple, but you know, this was one of those crazy days. I doubt that you ever would have held on all the way to the end, you know, for ours. But because we don't have a lot of risk here in the middle, you can wait it out until and see what happens. So this is not a problem for us in this strategy. We could have taken small profits and at worst taken small losses if we held on to it. So that's one case. Now, most of the cases, when you have some movement, you're going to end up near the end of the day without all of this garbage going on in the middle here. It's either going to trend or a semi-trend up or down, and you're going to end up in one of these profit tents, either in this guy or in this guy, right? But yeah, this morning, I took profits here, and that's what I called in the room, to take profits and also to lock in the loss here. So it was a minor profit. I think that if you had the SPX on, you probably would have made maybe $150 per position. So that's what I expect to see. I expect to see, you know, small profits and small losses while price, you know, stays in between these two. If it gets into one of these guys, then you start seeing outsized profits. Now, this is going to change our return distribution I think, dramatically in a good way. For one, we're going to have a higher probability of, or higher win rate. And I think we'll also have a higher resulting or return overall. But that's why we're doing the experiment and why we're going to, go forward and see what this turns out to over the long term. And here's the difference in the returns. Let's see, I have to go over here and put on this. I know you just love to see the iPad. So the big difference in returns, we currently have what you call a skewed right return distribution. So what that means is if this is a bell curve and you have even distribution on the minus and the plus side, right? Our distribution is quite a bit different. We have a skewed right distribution, which means that we have a bunch of small losses, a bunch of small wins, and then we have a right tail like this. So this is really where we make our money here. And this is the plus side, this is the minus side, and we're capped, maybe at $200. But this goes, 1,000 or more, right? This new way is going to flatten this out a bit. I think at the low end, we'll be at 300. We'll be able to manage at worst, 300, but it's not the kurtosis or the height here is going to be lower. But here, it's going to be thicker. It's going to be thicker than this. And it may not go up as high. It may go up to 800, right? But we're going to still going to get a very small number of losses. This might go up a little bit, but we'll say we get a medium number of wins, but we're going to get many more medium-sized wins and big wins, BWs. So that's going to be the difference in terms of what our expectations are. And where this is, say, a 50% win rate, this is probably going to be north of a 75% win rate. With very small losses, small wins, and so it's going to be. We'll probably still have a sort of a stair stepper equity curve. Our equity curve is probably going to look like this. All right, but the drawdowns are going to be smaller, and the volatility, the amount of up and down that we do here is going to probably be narrower too. So those are what we are expecting from the Batman trade. Overall, I think it's going to be a more enjoyable trading experience for people, especially if they're just not into a 50% win rate. And I think it's going to be more profitable too. At least that's what I've seen in my, the first few trades that I've done, and also the simulations that I've gone through, and also looking at the experience I already have with this type of strategy. All right, so there you go. Hopefully that tells you where we're going. Let's see. So how do you hedge that again? We hedge that with our pattern day trader hack. So when I say hedge, I mean that we lock in the profits by putting in the opposite trade. So if you have a put call, a long put call, you put in a short, I'm sorry, if you have a long put fly, you put in a short call fly with the same strikes. Uh-oh, we got a question here. Let me see if I got that right. A PDT hack locks in profit as long as you are in the profit tent. Or if you have any profit, you don't have to be in the profit tent. You can be anywhere, regardless of being on the right side or of volatility or not. That's correct. So wherever, so let's say that you're sitting here and let's do this in a different way. I'm going to show you this one more time. One more time, we go to the iPad. And I'll show you what happens with the PDT hack. All right. So we have a fly or any spread, it doesn't matter. And then let's say that our profit curve is looking like this. And we can be anywhere in this profit curve, but let's say that we're right here and we want to lock in that profit. We're right there. That's where we're at. We're right there. And let's say that this is a put fly, a long put fly. And it has these strikes, as this strike, and this strike. To lock in that profit, what we do is that we take a long call fly, a short call fly that will basically look like this. Right? And its profit curve will be somewhat, different. It's going to be the opposite of this. But when you put these two together, what's going to happen is you're going to end up with, I'm going to make it green, a flat line. The combination of these two will give you a flat line, and it will lock in profits right there. Does that make sense? That will be your new strategy with 6 strikes up there, and it will define that, and you'll have, this will be your profit that you locked in when it was right here on your profit curve. All right, does that make sense? You got that? Oh, was I showing that? I can't believe I wasn't showing that. So the cyan is your original. That is the short call fly that you put on top of the long put fly. And then this is the resulting profit line. Let's say profit is right there. Man, I wasn't showing that. I've just totally screwed this this whole live stream up. That's all right. We'll be talking about this many times more. But what I want to wish everybody is a happy Thanksgiving. I hope you have a great time. And for people that aren't in the United States, and if you are from the United States and outside the country, happy Thanksgiving. And if you're not from the United States, I hope you have a happy Thursday. So anyways, if you had held on to our strategy right to the end, you would have ended up with almost flat. So that's kind of interesting. But, it's been like that this past, oh man, it's been almost 2 weeks. We've been going just purely sideways. All right. Hopefully that this has been, as much as you were able to follow through, and with my ineptitude in pushing the right buttons and the failure of my black magic video switcher, which is unusual because these things are really workhorses. But we'll be back. We'll be back tomorrow until 1 o'clock. Maybe we'll do an early show, and I'll go over this again so that we can really lock this down. But we're going to be doing this now for the next 100 days or so, 100 trading days, and we'll be talking about this intensely and show you how you can make good money with very little risk and just a minimal amount of management. I mean, I'm not saying that this is easy. I'm saying that you still need to be able to be practiced and adept at putting on these, taking them off, being able to manage those profits. But I think overall, you'll find that this strategy and the process that we go through will be quite enjoyable. All right. Thank you very much. Peace to you all. And I hope you have a great Thanksgiving or happy Thursday, and take care. Thank you all for showing up and asking the questions. Really appreciate it. Music.